All right, check this out. If retail investors were polled about their losses in the stock market, it is highly likely that 8 out of 10 would answer in the affirmative. The remaining 2 have been fortunate enough to make profitable investments. Not for the reasons you may imagine. Most retail traders lose money. There's no hidden conversation where all the good trades are discussed and the markets are not manipulated. It's a simple fact that most traders lose money because they lack a plan. These losses may be significant. It's important to perform analysis, whether it be fundamental, technical, or quantitative, and trading with caution. However, they alone do not guarantee success. Emotions can cloud your judgment without a solid strategy and guidelines, leading to poor choices. Focusing on being right rather than safe can cause you to hold on to positions for too long or overlook potential risks, ultimately resulting in significant losses. As a retail investor, I have learned that unexpected challenges can arise. Let's work together to identify the causes of our misfortunes and develop a plan to mitigate them. Lack of information. Regarding the stock market, news and sentiment play a huge role. After closely monitoring over 50 stocks for more than a year while investing, I discovered that retail investors are often the last to receive news and opinions. As I mentioned, they tend to join in after the party ends. In my next point, I'm going to delve deeper into the issues of poor timing. Recently, one of the pharmaceutical companies received a US FDA warning, causing the stock to plummet by 15%. However, the big operators had prior knowledge of this development. While you may see comments on the web forums, those are not my conclusions, okay? Retail investors often assume that the big players have access to insider information. Unfortunately, they were again caught off guard and suffered significant financial losses. By analyzing the stock's trading history, it becomes apparent that there was a consistent selling a few days before the news was made public. The stock had reached a 52-week high a few months ago, but in just 12 weeks, it plummeted to a 52-week low. There were market rumors that one of the biggest institutional investors sold off all their holdings right before the news broke. When the stock fell, they bought back. Although these are just rumors, there may be some truth to them. As the saying goes, where there's smoke, there's usually fire. So my point is that ordinary investors need a level playing field to succeed in the stock market. Unfortunately, retail investors don't have access to the same information as larger operations, making it difficult to compete. Lack of risk management. One of the main reasons traders experience financial losses is their ineffective risk management. When trading equities, it's crucial to establish stop-loss orders and size positions accurately to limit potential losses. Even a single poor transaction could completely erase earnings without proper risk management. Wrong timing. It's often emphasized that timing plays a crucial role in entering and exiting the stock market. It's important to acknowledge that ordinary investors do not influence the market's trajectory. As we witnessed in 2015, despite the strong positions taken by ordinary investors, the markets produce negative returns. Investors must exercise sound judgment, and this is an ongoing process. When I suggest that you entered the market at the wrong time, it means that the big players are preparing to leave. Retail investors' entry point often coincides with major operators' exit points due to human nature. The argument is that only major operators can control the market. However, if the market has reached its lowest point and major players decide to push it upward, it can change directions. Poor position sizing. Determining the appropriate amount of money to invest in each transaction based on your portfolio size and risk tolerance is known as position sizing. It can be challenging for traders to grow their trading accounts when they invest too much or too little in each deal. To minimize risk, it's recommended to never invest more than 1% of your entire trading account on a single transaction. Analyst. I cannot disclose the name, but a famous stock analyst has a large following. Despite his recommendations, some investors choose to go against them. I tested this strategy and found that it can be successful. Investors sometimes take a different approach and sell when he says to buy and vice versa. I personally think it's more beneficial for investors to adopt a contrarian position against analyst predictions. You can consider looking on stocks with the largest market-wide consensus, buy ratings such as Axis Bank, ONGC, ICICI Bank, SBI, and Coal India. Emotional decision-making. Like all investors who participate in retail are susceptible to experiencing emotions such as fear, greed, and panic when making decisions. Emotional decision-making can lead to buying high and selling low, which is detrimental to long-term investment performance. Lack of diversification. Some retail investors may place their funds in a select few specific stocks, exposing them to high risks if those equities underperform. Risk management requires careful diversification across many asset classes and businesses. Overtrading and high fees. Retail investors who engage in overtrading may have higher transaction costs and lower overall profits due to the temptation to do so. Furthermore, certain investing platforms or financial advisors may impose excessive fees that outweigh potential benefits. Market volatility. Investing in the stock market can be unpredictable due to its inherent volatility. Retail investors who attempt to time the market or trade frequently may find it difficult to consistently generate profits in the short term. Information disadvantage. Retail investors may face limitations in accessing research and information compared to institutional investors or hedge funds when making investment decisions. Limited resources and time. Unlike institutional investors who have access to large research terms and resources, retail investors might not have the time or resources to properly analyze assets. Herd mentality. Retail investors sometimes follow the crowd and make financial decisions without doing proper research based on current events or social media suggestions, following rumors and hype. A common mistake inexperienced investors make is trading stocks without conducting thorough research and relying on hype or rumors. It's important to stay focused and ignore any rumors circulating. Lack of patience. Successful investing often requires long-term thinking, but some retail investors may lack the patience to hold on to their investments during market downturns. This could result in missing out on potential rewards when the market recovers. Short-term focus. Some investors may prioritize making quick profits over long-term gains, which could cause them to miss out on potentially beneficial opportunities. It's important to consider both short-term and long-term investment strategies. I recommend reading Trading in the Zone by Mark Douglas if you want to develop trading rules. The book emphasizes the importance of removing our psychological bias from trading decisions. As an experienced trader, I follow the 7 principles of consistency outlined in the book. These principles were given to me by my mentor when I first started trading, and I keep them posted at my trading station. The 7 consistency principles are: number 1, identify your trading advantages objectively. Number 2, determine every trade's risk in advance. Number 3, act on all trading benefits without hesitation or reservation. Number 4, completely take the risk or be prepared to let go of the deal. Number 5, make payments to yourself as the market provides you with funds. Number 6, constantly keep an eye on your propensity for mistakes. Number 7, recognize the significance of these rules for enduring success and the reason it's crucial to abide by them. The specifics of the stock market are too complex to comprehend. Successful stock traders require various skills, such as self-discipline, resilience, careful risk management, and a strong mindset. It's essential to avoid making decisions based on emotions like fear and greed, as this can lead to significant financial losses. Many retail investors achieve success through diversification, discipline, and knowledgeable investing techniques, and a long-term outlook. Retail investors can improve their investment outcomes by educating themselves, researching, and seeking advice from financial experts. So, what are your options? Should we abandon the stock market altogether? No. Despite the challenges faced by retail investors, a few key strategies can help improve our chances. First and foremost, education is key. We can make better investment decisions by increasing our understanding of the market, relying on trustworthy sources, and comprehending financial data. It's also important to focus on the long term. We should let time do the work rather than constantly monitoring our portfolio's performance. After all, Rome wasn't built in a day. Lastly, consider seeking advice from a financial advisor. They can help guide us through the complexities of the market and provide personalized guidance that aligns with our financial goals.